Hi, it's Connie from Prosperity Finance. I hope you're doing well. I know a lot of people are going through a very tough time at the moment due to COVID. I hope you and your family are keeping safe. Now, this week, I just want to express my frustration about the bank conversion rates. We have a lot of people couldn't be approved for the amount of a loan they normally can get. Due to a lot of reasons. The common one you probably heard over the media, the CCCFA, that causing a lot of frustration, a lot of disappointment. People with really low risk applications, they still get declined or approved much less for not sensible reasons. But CCCFA is not the only factor that affect the borrowing capacity. There are many more. So I thought it's a good time to consolidate those and share with you so that you are aware of them and can take some actions about that so that your journey can be more smoother. Okay. Now, as usual, I like to present my analysis through some visual aids. And today I prepared a table I'd like to share with you. So let's have a look now. So I have a table here so that basically categorize the changes based on the type of change. And then I'll talk about the driver that affect the change. And then I will cover the impact group and the level of impact. So the first one is the increase of rental shading. Bank never take gross rental income because as an investor, you will have some expenses associated with owning the property, such as rates, insurance, and vacancies, etc., maintenance, accounting fee. So bank always apply a discount, but now they discount more, even more. And the driver of that are both the CCCFA and the interest deductibility rule that the government introduced last year. Now, CCCFA, if you have not heard about it, you can watch our video we shared maybe a month ago that has more kind of a explanation and impact. But just in summary, CCCFA is meant to protect vulnerable people from getting a higher interest, higher kind of finance cost by those loan sharks. It's not really for majority of the borrowers, but now, unfortunately, this is what's happening. Okay, they're trying to protect you, but I think it's just overdone. So as a result of a CCCFA and the interest stability, the bank apply less income against rental income, basically. And the impact group, obviously, property investors, you have to have rental income. The impact level is probably moderate in my view, because there's always a discount. It's just more discount. So I think it's called moderate. It's fair. The next part is also impact on property investor. That is when your existing loans are on interest only. Before the CCCFA changes, you probably have a lower repayment in some bank size because they basically work out your current payments, which is just interest, and they add a small margin on top. But now all lenders are treated as a principal and interest. So it's a huge difference between what you are paying versus what they think you should pay. So you will have a less disposal income to cover new lending, basically. The next one is the test interest rates. So test interest rates is different from the actual interest rates. Test rates, but it's driven by the actual interest rates. Now, you probably noticed that the interest rate have increased many times since August last year. As a result, the test rates also increased, and it's always above the actual interest rates. So the tax rates, it's not only affect the new loan, but also affect existing loan, despite your actual interest rates. So this impact is for everybody who need to borrow money. Okay, it doesn't matter your first home buyers or investors, you will be affected by a higher tax interest rates. So that's why it's severe. And the magnitude of that increase is, big. Okay, let's look at the next one. More expenses are added to the living expense for investment property, for the rates and the insurance. So that's the council rates and insurance. Now, in the past, when the bank apply your rental income discount, that discounts already take into account the expenses, such as rates and insurance. But now they had more discount, and also at the same time, they apply additional expenses and added to your living expenses. So kind of it's a double whammy. You have less income, but more expenses. As a result, you have much less disposable income for new lending repayments. Okay, so that has a huge impact on borrowers who have many rental properties. The next one probably been talked the most. That's the scrutinization of the living expenses. And some banks do add up manually for all your living expenses. So they add up to $1. Okay, so the difference between the bank minimum living expenses versus people's actual living expenses are huge. Especially we are in March now, just early March. So a lot of expenses happened in December during the Christmas, New Year time. So people were on holiday, so they tend to spend more. So the average of the last 3 living expenses are far more the bank's minimum. Now, before the change of the CCCFA, banks are quite relaxed about this. They understand that for people who has a good repayment history, as long as you had good repayment history, they don't care if you spend a bit more, because they know if you really tight on your mortgage repayment, you will spend less. They are discretionary expenses, okay? But now they don't distinguish discretionary and essential. They just add them up into one number, okay? That caused the most distortion. A lot of people's application was heavily affected by these changes. The next one is the introduction of DTI. Now, DTI is debt to income ratio. Some banks already had this, like a BNZ, the ASB, and Bank of China, but some banks has not applied this yet. Now, this rule definitely applied to every borrowers, but because there's some other options, like the banks who hasn't introduced this, and the primary non-bank lenders, they don't have this. So people have other options to go. So the impact is not huge. You have an alternative. The next one is to do with the income tax changes last year. So if your personal earnings over 180K, you expect to pay more tax. As a result, without the pay rise, your net income will be less than before. So it, as a result, affect your borrowing capacity. It's only affect people who has really high income over 180K, so the impact level is mild. Next one is to do with self-employed borrowers. Because of the COVID, we all are affected in a way for, by the COVID for our business. It depends on the industry. The impact can be quite significant, like hospitality industry, tourism industry, etc. That's the business were heavily affected, and in fact a lot of business had to close in the end, but some other business can still operate, but at a reduced volume. Okay, so bank discounting business incomes, as a result your borrowing capacity would be less due to the business income reduction. the very last one is for people who are over 45. Now, bank wouldn't discriminate people against age. However, that's to do with the CCCFA, because the CCCFA is meant to protect people, vulnerable people. So if you're not intended to work for another 30 years, then why bank would give you 30 years long term if you buy a home? So unfortunately, if you are in that age bracket and you are buying home or upgrade home, you wouldn't unlikely to get 30 years long term because of that. But for buying investment property, that has no impact, because you can always sell rental property to clear the debt. You can't sell your home and live on the street. So the impacts are moderate because it's not a big kind of group of people affected by this, and it's only for people over 45 with buying home. Okay, so that's pretty much the summary of the changes over the last 3-4 months. So just so give you an idea what the impacts are. So you can see that affect everybody. The first home buyers definitely get affected by tax rates, by living expenses scrutinization, but investors not only have these changes impact, but also other more. So yeah, it's not easy for everybody. Now, as a result, what we noticed that the property market is really quiet. People who wants to buy property, they can't get enough funding to buy, so they don't go to open homes. And the vendor who want to sell properties, they don't get good buyers, so they don't sell. Now look at the developers. They hardly can get funding at the moment. They can't meet the pre-sale condition. They don't have even funding from finance company, because the finance company, they are running out of money. Because their money were lent to other developer, but the money was returned late because the project was delayed due to lack of material, etc. And the banks declined all application, so that fall into the finance company kind of market. So they have a big market to absorb. So they're really cherry picking, and their funding are really, really tight. So it creates a supply problem. Okay, and I don't think it's healthy, because people couldn't buy a home, which is not the desired outcome of those changes, but that's what's happening right now. Okay, so the government are reviewing the CCCFA. It's not the only factor that drives the borrowing capacity issue, but it's definitely one of the the most significant driver, I would say. Hopefully it's getting easier later on, but I don't really want to wait. It can take a few months or even a year to see the changes. So in the following content in the near future, I'm going to pick a specific kind of changes and talk about the solutions, so that you can take action immediately. Your journey can be smoother. Okay, so please keep your eye on these future video and articles. Okay, thank you so much for watching this week's content. I hope you find it useful, and please take care. I'll see you next week. Bye for now.